Hello, this is our final section of the video. We are now going through the nitty-gritty C++ coding right here in the C++ CPP subdirectory. Couple of PDFs we're going to work with here. First one is this one here, uh, optimal HFT market making hybrid approach using this AS model and order flow and balance. There's another separate video, most likely go through the HTML of the slide deck. This is the first time I'm able to showcase both the algorithm and code snippets together on the same slide. So show that. We also have the source code and some other documents as well, the PDF, how to build and another way to look at the coding and the algorithmic development of this kind of like a high frequency trading system, all self-contained. So, here's a source code. Okay, again, I've said this before. This is now being built within a Windows subsystem, subsystem for Linux. Okay, I'm using Ubuntu. So I'm assuming you know how to set that up, set up all the dependencies, blah, 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 with the source code. The compile process is fairly easy. So we'll get into that. Here's the source code right here in the appropriate environment for a WSL. Uh, with the source code and plus the bin files. So when you run the bin file after compiling and linking, it's basically building. That's what it does. Now there's different parameters. You'll see that in the documents, but just generally, we're doing a back test. We're running 100,000 simulated ticks. Here's our parameters here. The default, doing a back test, gamma parameter 0.1. The K parameter, I'll tell you what these are in the other documents. The run beta, we also have, this is the interesting one, is the ability to, on the throughput of over 2 million per second, 2 million ticks per second on a really good system, can run in 25 milliseconds. And here's the back test results. You can change this. Starts at 100,000, total P&L, unrealized P&L, max drawdown, Sharpe ratio, which is kind of out of whack, trading statistics, all that, and all the usual trade quality, um, latency, and the final stats as well, cache inventory, volatility, and OFI signaling. So there's different parameters you can assign in the argument list when you run this. So you can do that as well. We'll go over that in a next video, a couple of minutes. I don't know. Anyways, let's look at the very first PDF here. So when you come in here, here's the HTML slide deck I'll show in a separate video. That's a fairly long one. This one here is the first PDF that we look at. So this one's optimal high frequency market making hybrid approach using Avaleyenda, Stoikov, and order flow imbalance. We got our usual blurbage. But here's the interesting, with as it is, with the current data that I've talked about, we could get a Sharpe ratio over 3, which is pretty strong. Involves short-term alpha signaling derived from the order flow imbalance as well. There's this research paper. I think there's citations in the, where to get that paper for what we'll call the AS model in 2008. There's a lot of things here we can look at. So study details the mathematical derivation of optimal coding, microstructure of the limit book, order book, and the practical implementation of the strategy in a latency sensitive environment. As I said all the time, this is really for demonstration purposes. I'll even go for entertainment purposes. If some people may take it that way, that's fine. But here's what we're dealing with. So as I said, prior videos, market making was purposely chosen. For this data set, this is not the best performing strategy out of the ones that I've shown in the back testing. This was only chosen because it's the most popular. This is what most people respond to. So I've included that. That's for high frequency trading. So I'm not going to explain what market making is, but it's just looking at the profit between a bid and ask spread, buying at a lower price, selling at a higher price, attempting a risk of holding an inventory. There's a fundamental dilemma facing any market making is a trade-off between execution risk, the risk that the orders not filled will go in Y, and then an inventory risk where the risk of the asset price moves against the held position. Now, this is specifically in classic high frequency trading. Certain firms they can modify all of these equations I'm showing you. Can have adverse selection here. And a lot of people that will do this are usually news traders and they're informed or arbitrageurs. So my Futures and Options course covers that. Um, and they will trade against the market maker sometimes if the market maker quotes get stale. And the most profitable strategy is not merely one that captures the widest spread, but effectively uh, dodges toxic flow and managing inventory to zero. So this is what we're kind of focusing on. Here we're trying to deconstruct the microstructure of the provided tick data, um, and more importantly, identify the volatility regimes and arrival date, the AS model to determine optimal reservation price, also enhance the base model with an order flow imbalance signal to predict short-term price drift, and a rigorous backtest built into the coding here on the simulation to quantify the profitability. So in this PDF, we're going to talk about just purely the equations, not showing you any of the code. I'll show you the formulas as well, all the quantitative techniques as well. So the microstructure fundamentals, you have a limit order book, dynamic queue, and then we have T for time, mid price, and ST defined as this, and then the price of the best ask and the best bid. We're looking at the spread distance between the mid price where the orders are placed, and again the skew, which is the shift in quotes based on current inventory. This really mostly works in options and a blend of futures. This is going to use a lot of the option chain data. I've shown the data, tick data that is, and it's just bid ask spread and volume. And for the AS model, it's a stochastic control problem. So here we're trying to maximize expected utility of terminal wealth while penalizing the inventory variance. So here, this is mid price is based upon Brownian motion with this formula here. The market maker bids and asks on the model, which are a Poisson principle, where there's an intersection where there's decay exponentially in the model as the market making widens the spread. So A and K are parameters estimated for the historical tick data. So we also have something called reservation price, which is the core solution in the AS model. The price at which the market making would be indifferent between the buying and the selling. It deviates from the market mid price based on the current inventory. So when you have an infinite horizon of HFT, where T to infinity is not applicable in the same way. The different process right here, where we have current inventory quantity, positive for longing, negative for short. That's key. We also have risk aversion parameter and a market volatility, along with the optimal bond and the optimal ask. And the quote is based upon around the reservation price. So here's the um, optimal market value. And then we have the order flow imbalance. This is all going to be seen in the code. Was a martingale, mid-price martingale, random walk. Order flow contains predictive information. If there's a surge of aggressive buy orders, the price is likely to tick up. This is how accurate it is from a mathematical standpoint. The DFI, OFI, or time winner is defined here, where V represents the volume of market orders. Modify the reservation price in the alpha term, creates a hybrid strategy where you have an inventory awareness on the AS and momentum aware on the OFI. So their data analysis parameter estimate. Now, as I said, we are able to generate our level one tick order. I've shown that with the 2 days worth in early January. Um, and in there, you get time, price, volume, and the side. If it's buy or sell, long or short. And the data pre-processing, we have to remove erroneous outliers and erroneous print. Aggregate the ticks into a 100 millisecond snapshot. Uh, Estimate the volatility and arrival date, and tick by tick noise can distort the estimation. So we have ways to filter all that out or smooth it over, call it what we want. Here we have the volatility is crucial for the inventory penalty. Calculate the realized volatility using rolling window of the past 10 minutes. You'll clearly see that in the HTML presentation, the slide deck there. Very, very visual there. So we have also some intensity parameters, A and K. To solve that, we use a regression analysis on the probability of the fill given a distance from the mid price. Take the natural log of the intensity function right here. And the plot. Now there's a Python coding example of that, but then we also have the actual, quite possibly production ready, live ready, with the uh, market making HFT code that I'm showing here with the C++ again for demonstration purposes. So we plot the histogram on the execution from the mid price, perform a linear regression to extract the slope and the intercept, A and K. So this is one of the big things because of AI now and where we're at. We are able to see on the results of these parameters or the calculations, what do we do? That's the important thing. And a lot of the gurus don't talk about that. The books don't talk about that. So it's kind of like a first time to showcase what to do when this happens. So when a K is approximately 10 to 50, it indicates a fill probability and it drops sharply as the spread widens. So A, between 0.5 and 2, we have a base arrival rate. Okay, so what do we do with the implementation logic? As it said here, we're going to showcase the state of the limit order book and the market making internal state. So here's that Python simulation code that I talked about. Here we've got our gamma, which is a risk aversion parameter. K in the order book liquidity parameter, decay of fill probability. A being the base arrival rate and the window size. And again, you'll see that better in the, because it's all repeating. You'll see that in the HTML visual slide deck. So we have a look back window as well for volatility calculation. And here's all the different coding for that. We have a state variable, do a run a back test. Use take data, data frame with columns, timestamp, price, volume. That's all here. Go through loop. We'll calculate the reservation price using that AS. Scale the sigma for time, assuming ticks are high frequency. We calculate the optimal spread where we have a simplified for infinite horizon. Third, we have a simulation of execution, which is really the matching engine. This is the critical part when you look at the CME and Aurora with their matching engine from Globex that they bought. That is what the data center does. We have all these market participants put into one data center, and they're all participating with all their trade execution, getting prioritized by the pricing matching engine. So here we do a real back test to check if the market trader through a limit and assume if a trade happens at a price worse than ours, we get filled. So that's kind of like the hopeful logic there. If the taker, this is key to understand this logic. This is kind of real secret sauce stuff. So if you have a taker sells on the side of selling and the price is less than the bid, you buy from a simplistic standpoint. If a taker buys, side being buy, but the price is greater than our ask, we sell. Sounds basic. Then we have a mark to market. And then at the end, we have our mock data generation for demonstration with all the stats, plots that get uh, outputted. So we have here in the code explanation of this Python coding, you have a class track cash inventory, which is separated, and the equity is calculated with the cash plus the inventory times the mid price. Then we have the reservation price, which is really, as I said, the secret sauce of the whole thing. The reservation price subtracts inventory times gamma times sigma squared. So this is the logic here, what to do. Again, this is not really talked about at all. If the inventory is positive, we're long. Reservation price moves down. This lowers both the risk, our bid and ask, become more aggressive with the sellers. Ask is closer to the mid, and the conservative buyers bid is far from the mid. So again, on the flip side, if inventory is negative, we're short, which basically means that the reservation price moves up. We become aggressive buyers to cover the short. So on the execution logic, we assume a conservative fill. Only assume a fill if the market trades through our price. This accounts for the fact that we are not at the front of the queue because unless you have a big account and you're paying for that access based upon a call it a pay to play model that the CME like, the more you pay, the better access you get on the matching engine. So level 3 data would be required for the queue positioning simulation. That's far beyond the scope of what we're trying to do here. So on the performance results, we have the equity curve analysis. We have the running simulation on the tick data. Strategy exhibits a characteristic staircase equity curve, which you've seen in the Python application. The profit source, the strategy earns the spread repeatedly in ranging markets. And then we have a loss source with a sharp unidirectional trend. Price crashes and the strategy attempts to catch the knife by the dip. You've heard that before if you watch a lot of the financial news or follow a lot what the Bitcoin bros do due to mean reversion assumptions. Now, right now, I think the assumptions are no longer valid. Everyone seems to think that Bitcoin trades around patterns, cycles, 4 year, whatnot. I think now where we're at, that's kind of broken down and accumulate a long position that loses value. Okay, so inventory management. Okay, so the second subplot of the code shows the effectiveness of the gamma parameter with high gamma when the strategy hates inventory. It skews prices aggressively to dump positions immediately. So you can see on the price action here that this usually starts at this level where the liquidity and volume is in the futures and options market, specifically where the volume is the king. Most likely the CME will be the largest volume source outside of Binance, maybe at the retail spot level. So what you're learning here with the CME will have a huge impact on the direction and price of Bitcoin. Um, and that's why it's good to know this at the crust of it instead of chasing the return through charts or through fundamental or intuition or just plain old guessing. So here, if we have a low gamma, the opposite tolerate large swings in the inventory, acting more like a directional trader. So again, we have our metrics in the Sharpe ratio. This is the target that maybe 10,000 ticks could be, where we try to have a Sharpe ratio of 3.2, annualized max drawdown. Like to have this high Sharpe ratio with a very, very, very low max drawdown, like the standard is 15%. This is well within that threshold. And yet you're still delivering a 3 or more Sharpe ratio. This is definitely obviously a winner. As I said before, if you want to get the attention of the hedge funds, family offices for external capital, you kind of want to show a much higher Sharpe ratio where it's verified over time. Again, here with a profit ratio of 1.85, that's pretty good. Anything over 2 in the world of trading view is pretty strong. We have a win ratio here of 62%. Very good. I've seen as high as 97%, and I do believe that that could be true. You have to test and run it and actually put live money on it to see how it runs. And then again, we get into the more nitty gritty on the high frequency trading terminology. Primary failure mode of the strategy is toxic flow. So these are adverse selection protection that we're building into the code. This occurs when the strategy buys from a trader who knows the price is about to crash. Does that sound familiar if you're dealing with a large HFT provider or trader? They know they're planning to make a crash through their manipulation through via various means. I said before, the regulators are trying to address that and get rid of it, but the problem is that these trading participants, the big ones, market making, HFT shops, whatever the regulators bring in, there'll always be a cat and mouse game going on. They'll be again ahead of the curve and find other ways to manipulate the market. We just don't know about it. But I personally think with the advancement of AI that we have the capabilities to learn what they're doing, not in real time, but in recent times when that happens. So to mitigate what we're talking about here, and you can do it mathematically, we have a micro price adjustment. Instead of using a simple mid price, we use a volume weighted mid price of VWAP calculated here. So again, if the volume on the bid is much higher than the ask, the micro price shifts upward, signaling buying pressure. Okay. So again, that's just from pure math, pure data, how the data flows, that we can get a really good, convincingly buy signal. So here's some of the latency considerations. Again, as you go through this code, you'll see that there's better ways to circumvent all of these latency issues. So obviously, with the speed that brings in alpha, all the unique advantages that you get brings in alpha. So this is what we're talking about: is the time from receiving a market data packet to sending the order out with an update. And obviously, we're going to go through various ways to uh, optimize. So with the sample code I just presented with the code, that's for research. Where you want to do the production implementation is going to be usually in C++ or soon to be Rust, using different techniques that the FPGA boards can give you with further hardware acceleration. And that's for network processing. And the whole idea is to get that under 10 microsecond latency. So again, with the limits here, with a hard stop, if the Q is greater than the zero max, where we have to switch to this liquidation mode. There, the market making places market orders, taking liquidity to reduce the inventory and accept the cost of the spread to eliminate the catastrophic tail risk. So again, this is the first PDF we're showing. In conclusion here, we have the research paper demonstrated by this hybrid AS strategy calibrated on HFT, high frequency trading tick data, providing a robust framework for market making. Now, again, this is just one of many hundreds, probably thousands examples of strategy coding that you could look at and analyze and implement with based upon, in this case, just one small snapshot, 2 days worth of tick data when overall the Bitcoin market was flat. Again, I've said that before, that's the hardest market condition to be in. So we dynamically adjust the reservation price based on the inventory level and the volatility. The strategy itself, because it's all self-contained, it can effectively monetize the bid and ask. So also we have the order flow imbalance. That's a filter, a critical filter, preventing the strategy from providing liquidity during moments of high directional toxicity. When running the back test, which we've already done by either the back, well, compared to other strategies, we've run the back test both in JavaScript and Python. We want to show a high Sharp ratio, real world deployment with a rigorous infrastructure, optimization to minimize the latency and manage the winner first. Inherit and limit order trading. So future versions, you could do this through AI and approach it with adding reinforcement learning. And now you're talking agents here. where it has optimal mapping, where you have an inventory volatility, OFI, to spread skew without relying on a closed form assumption of the AS model. So here are your references, including the AS paper and the like. Okay, so you can find it in that document. So next step, what we're going to look at here is the code itself along with the uh, build. All right, so here, as I said, we've got the code, and if you're running Linux, a bin file might be there. If not, you just create a new bin file, executable, essentially, and recompile and build with the instructions which I'm about to show you. So here's the build and deployment of this particular strategy. Okay, so we need to, in your Linux environment, and again, I'm assuming you know you're an accomplished C++ programmer. I'm assuming you know Linux. I'm assuming you also know Python and JavaScript as well. You don't have to be an expert here, but we go to a point that we can with instructions on how to set it up. So initially in your Linux WSL, I'm using Ubuntu 22. We have our updates and our essential as well. We have all our Linux tools as well, which I would build. We also have a basic build right here well, you have the subdirectory already created for you, blah, blah, blah. This is the key one right here is the build itself of the compilation, including the linking as well to create your new bin file, which of course is the HFT market making along all from one C++ file. I keep everything as simple as possible, even though some will say it might not be the best method. But I do everything in one file. Okay. It's a fairly lengthy file. I'll show you in a minute. So here we can also maximize performance on the build, on the compile. This thing also has a help file right here. So just as an example, so you can get all of the available help right here with all the different switches or argument list as well. And then we have, again, usage examples right here. Now, if you want to tweak your Linux environment for so-called ultra low latency, you can run the shell script right here. So what we're doing here, we can disable the CPU frequency scaling from run it as under root access. We disable the transparent huge pages. So what we're doing here is we're trying to minimize as much jitteriness out of the OS. The more jitteriness we can remove or control or minimize, the better performing you'll get out of the C++ executable. So here we have inactivate a network buffer sizes. We have here disable the IRQ balance and then run as well. And then we also can add in CPU affinity as well with a back test. And then for real time, potentially, you can only do this as root. And then you can run this combination as well on the actual bin file itself. You can also provide a CSV file. And here it processes or potentially can process 1 million ticks per second on typical hardware. That's fast. You'll see why once we go through the coding breakdown. So you can do a tick to quote latency under 1 microsecond when it's properly optimized with what I just shown. Okay, so let's check out. Here's some of the output I've shown already. Okay, so let's check out the code itself. Again, everything I'm showing you, PDFs, reports, the coding, everything is 100% AI. Okay, so this is AI. You can see here the entire code for this is 1,700 lines. I'm not going to go through the code itself because I'm just basically repeating what I'm going to show you. But more importantly, I'm going to go in another video involved with the coding breakdown, but I'm going to show you two ways. there's this way and then this way as well in the HTML that I've shown. So we'll do that in the next video.